Hello learners, welcome to this session. My name is Beatrice Juguna. I will be taking you through this unit, BAF 2202, Management Accounting 1. On our lesson 1, I want to introduce you to management accounting, briefly look at nature and purpose of management accounting, and then proceed to look at decision making. And so on our first item, I want us to look at the definitions of the various accounting subjects. And to start us off, I want to look at what is management accounting. Basically, management accounting is the application of professional accounting knowledge and skills in preparation and presentation of accounting information in such a way as to assist management in formulation of policies, planning, and control of the operations of an undertaking or a business. And if you compare that to the other accounting subjects, then cost accounting can be defined as a formal system of accounting by which the costs of products and services are established and controlled. Financial accounting, on the other hand, which you have discussed previously, is the process of recording, classifying, summarizing, and reporting financial information used in making economic decisions. To distinguish the three, therefore, we can clearly see that financial accounting is about reporting, and so we dwell much on preparation and presentation of financial statements, the income statement, the cash flow statement, and the financial position statement under financial accounting. Cost accounting basically will dwell on establishing the actual costs incurred in production of services and products. Now, our topic on management accounting, then we will be looking at applying both financial accounting information and cost accounting information, the application part of accounting, basically with the aim to advise managers to make better decisions. And so management accounting is more about planning, control, motivation, communication, and organizing. So looking at the role of management accounting, then we can agree that planning is setting of objectives, determining what needs to be done to achieve the objectives of an organization. Now, the role the management accountant plays is that he or she helps formulate future plans by providing information to assist in deciding what product to be sold, in which market, and at what price. When it comes to the second role, then control, management accounting aids in the control process by providing performance reports. You will remember from your business studies class that control is basically the comparison between the actual outcomes and the planned outcomes. And so in this case, the performance report, as reported by the management accountant, act as a tool to help in that comparison, and where need be, then we respond to divergences. The third role is organizing. And organizing is basically establishing units, sections, departments, branches in an organization where functions will be carried out. And this is done purely based on how identical the functions are. And so the organizing function in a business setup is quite crucial. Now, the management accountant will provide information on the performance of each of those segments, units, or branches. Now, moving on, the third is motivation. And we are saying motivation is basically increasing the morale of employees. And on this, then we are saying that budgets and performance reports, all coming from the management accountant, are basically used to motivate the firm's employees. This can only be achieved, however, when targets are challenging but then achievable. And the last role of management accounting is basically communication, and we are saying whether we are doing budgets or whether we are providing performance reports, then we are saying basically we are aiding the communication process. It is good to note that budgets used as either planning or control tool are effective communication tools in an organization. When used for planning, then budgets basically communicate to the employees on the targets that they need to achieve. When used for control, then they will respond to the various issues raised from the budget comparisons. And moving on our introduction, it is good to highlight the differences between management accounting and financial accounting. Now, looking at financial accounting being basically the recording, summarizing, classifying, and reporting financial information, all the way from where we prepared ledgers, we actually went to the cash books, we did journals, we prepared the income statements, the financial position statements, the bank reconciliation statements. Then we are saying there are quite differences between what we did in financial accounting and what we are doing in management accounting. Those differences can be split in several points, and the first I want to discuss is actually the legal requirements. And in our business studies class, we said that it is a requirement under the Companies Act for companies that are registered to report and publish their financial statements. And so in this case, we are saying financial accounting is actually a statutory obligation, while management accounting, being that it is there are reports that basically advise management, then it is optional. Some organizations need the management report, some organizations do without the management accounting department. The second difference is on the accounting principles. And from financial accounting 1, we looked at the principles, concepts, and conventions of accounting, which for financial accounting, for us to prepare financial statements, then we need to conform to those principles, what we call the generally accepted accounting principles. And these principles are quite many, but then we have to choose the concepts that we apply in our accounting procedures and conform to them. With management accounting, however, the generally accepted accounting principles are not applicable, and so we do not have to conform to them. The third difference is on time dimensions. As always, financial accounting reports on past events, what we have already sold, bills we have already paid, and so on and so forth. And so we are saying financial accounting looks at past events or reports on past events, while management accounting, basically being about decision making, about planning, then focuses on the future. And so we can say it is futuristic in nature, but then in that highlight, it is good to note that management accounting also uses past information to analyze and generate plans for the future. The fourth difference is on reporting frequency. Again, under the Companies Act, the regulation is that financial statements will be published annually. It is good to note that some organizations, especially those under the financial industry, banks and insurance companies, will provide those reports semi-annually. And so generally we can say that financial accounting reports are actually reported either annually or semi-annually. But then management accounting reports are prepared as needs arises. If the managers or the decision makers need to make a decision, then we will actually, as management accountants, prepare reports as and when they are needed. That could be daily, weekly, monthly, and so on and so forth. Then the fifth difference is on scope or focus. And it is good to note that when we report the income of an organization in our income statement, then we report the whole organization, how it performed for that duration, whether it is 6 months or it is annual report. And then on the same when we are reporting financial position. We will be reporting the net worth of a company as at the end of the year. And so generally we are saying that financial accounting focuses on the whole organization, while management accounting will go to the individual segments. We will analyze products that are not doing well. We will analyze how well a segment is doing, a department, a section, a branch, and so on and so forth. And so for management accounting, the reports will target or focus on an individual segment of the organization. And the last difference I want to look at is the type of information. And in this, you will remember from financial accounting class that we actually had a principle, money measurement principle, that actually indicated that we will only record quantifiable data that can be monetized. And so in this case, we are saying financial accounting basically looks at quantifiable information, while management accounting will go further in scope and look at both quantitative and qualitative. When we look at a product in management accounting, we may not narrow down to just the value or cost of that product. We will go to the quality and other qualitative parameters of that product. Moving on, I want to leave you with this for your further reading on the introduction. Look at the attributes of good management accounting information, and also look at conditions for effective management accounting system. So on our next item on the course outline, topic 2, we are supposed to look at decision making. And decision making basically has 3 areas that we need to discuss. The first is decision making process. The second is the decision making conditions. And then we also need to look at the decision making techniques. And the first I want to highlight is the decision-making process, which has been covered in your business studies class, in your principles of management class. But then again, we need to highlight the steps, the 7 steps that are involved in making decisions. And the first one, as always, is to identify objectives. What do you want to achieve as a business in that scope, in that financial year, in that strategic plan? What are the aims and objectives of the period? Then we have number 2, we need to search for alternative courses of action. Because in every objective, you will have several ways you can achieve that. If you want to increase profitability, then you can increase sales, you can move to new markets, you can introduce new products, you can activate promotions, and so on and so forth. So what alternatives do you have to achieve your objectives? Step number 3 is gather data about the alternatives, and in this case, we are saying that we will have to require data to be analyzed, whether this data relates to costs, whether it relates to the amount of revenue, whether it relates to the profitability for each alternative. We need to gather data about each option that we have. And then moving from the data, then we can be able to evaluate and select the best course of action, and that is our step number 4. And once we are able to identify which alternative we go for, then we implement the decision. In step number 6, we will be looking at the control part of that process. We will be comparing the actual and planned outcomes, because we have our planned outcomes. This is what we wished to achieve. And once we have implemented the decision, then we have what we actually achieved. And in that step, then we compare what we planned versus what we have achieved. And the last step in the decision-making process is to respond to divergences from the plan. How far did we achieve our plan? Is it a positive deviation? Is it a negative deviation? In each case, we need to ask ourselves why we were not able to exactly achieve what we planned, and then address those deviations. So in the next, we will be looking at decision-making conditions. And we have four conditions under which business decisions are made. The first one is certainty environment. And basically what we are saying is that in this environment, complete information is available as to which states of nature will occur. And we also know basically that the probabilities, the costs, the revenues of each states of nature. And when we talk of states of nature, then we are looking at the outcomes. For example, if we are talking of a farmer, like we will be looking at such an example, a farmer who wishes to decide on which crop to plant, then the amount of rainfall experienced is actually an outcome, something that will affect the profitability of that farmer or the revenues generated, but the farmer does not have really any control over them. And so we are saying basically, in the certainty environment, the states of nature that will occur are known and the information is complete and certain. But then the decision-making process in that case just involves picking the best alternative now that every information is known. Now the second condition or environment is risk. And we are saying when we talk of risk in business, then we are talking of uncertainties. And in this case, we are saying that the states of nature are not certain. But the probability distribution can be assigned. So yes, we are not very sure the amount of rainfall that this farmer will experience. We are not sure whether it will be high, moderate, or low, but then we can accurately give a probability of each scenario. Based on, of course, the historical events, we can say that the probability that we will experience high rainfall is 30%, moderate rainfall 50%, and so on and so forth. And so moving on, the third environment under which business decisions are made is fundamental uncertainty. And we are saying in this environment, the states of nature are not known, nor are the probabilities for the same. And so in this case, the decision-making process depends on the risk attitude of the decision maker. And we will be looking at risk attitudes at a later stage in this topic. Basically, what we are saying is that when there is a lot of uncertainty, then we will depend on the decision maker and what kind of an attitude, whether they are risk-seeking, whether they are risk-neutral, or they are risk-averse managers. And the last decision-making condition is actually competition. And basically what we are saying is that under decision-making, under competition, we are looking at a scenario where business decisions are made based on what the competitors or those with opposing interests are doing. And this is very common in our business environment, where you find one company, especially the market leader, moves on to do something, and then all the others follow in that suit. Now, the risk attitudes I mentioned before are three, and the first one is risk-seeking. And we are saying that a risk seeker is a decision maker who is interested in the best possible outcome. Now, this is independent of how small the chance of that happening is. So this is a risk-seeking manager who is optimistic in nature, looks at the maximum returns that can be earned out of a project and wishes to maximize the returns. Generally, we will say that the marginal utility for wealth is positive and increasing. Now, the second type of a manager that we can look at is a risk-neutral manager. And we are saying that this is a decision maker who is concerned with what is most likely to happen. And so in this case, for them, they do not consider risk, whether there is high risk or minimum risk. They are basically looking at the highest probability of an event happening. And then therefore in this case, we are saying the marginal utility of wealth for this decision maker is positive, but then constant. And the third and last is a risk-averse manager who acts on the assumption that the worst possible outcome will occur, and chooses the decision with the least risk. So the risk-averse manager is one who wishes to minimize risk. And so for them, the marginal utility of wealth is positive, but then decreasing. And moving on, we can move now to the techniques. We have several techniques that can be applied by a decision maker or the managers. We have what we call the Maximax technique, the Maximin technique, the Minimax regret criterion. We have the Laplace criterion of rationality. We have the expected monetary value, expected opportunity loss. We have the standard deviation, variance, coefficient of variance, decision tree. And in this class, we may not be able to look at all of them, but then we can proceed to look at the example that is given. We have a farmer. In our example, we have a farmer who wishes to decide on which crop to plant in the season, and the data below is provided. So in this case, the farmer has actually three crops to decide on, and these are what we are calling alternatives. We have wheat, we have beans, and we have maize. But then this farmer has three states of nature, or what we are calling the conditions. We can experience high rainfall, we can experience moderate rainfall, and we can experience low rainfall. So we have a matrix here, a 3 by 3, where now if we plant wheat and there is high rainfall, the farmer will earn a payoff or a revenue of 16,000. If we plant wheat and there is moderate rainfall, the farmer will earn 2,000. And then we will have the last one. If we experience low rainfall, then the farmer will actually incur a loss of 4,000. Then we have beans, and we have high rainfall. The farmer will earn 12,000, same as moderate rainfall. But then if we experience low rainfall, then the farmer will only earn 7,000. And if we plant maize, regardless of the amount of rainfall, the revenue coming to the farmer is actually 10,000 for all the states of nature. Now we need to highlight every single technique using this example, and I will start with Maximax. Now the Maximax technique is actually an optimistic technique that wishes to maximize the maximum returns. Now maximum returns is where we get the name Maximax, because we are maximizing the maximum returns. This technique is basically used by very optimistic managers who want to get the best out of the best alternatives that exist. If we go back to our example, then if we plant wheat, the maximum we can earn from wheat is actually 16,000. The maximum we can earn from beans is 12,000. And the maximum we can earn from maize is 10,000. And so in my calculation, I have maximum, which is 16 for wheat, 12 for beans, and 10,000 for maize. And so the maximum out of these maximums, 16, 12, and 10,000, the maximum is 16,000. And so this becomes our Maximax. And so the decision is to plant wheat because it gives the best of the best alternative. Now, if we look at the second technique in our list, then the next is Maximin. And in Maximin, then we are saying we are maximizing the minimum returns. Now, this technique is applied by pessimistic managers, those who wish to actually get out of a worst case scenario. So they first assume that we are going to have the worst case. Then out of that worst case, what best can we get out of it? So we are calling them pessimistic because for them, they want to minimize risk at whatever cost. So going back to our question, we have maize. The minimum we can earn is actually a loss of 4,000 from wheat. The minimum we can earn from beans is 7,000. The minimum we can earn from maize is 10,000. And so if you look at my table for that, then you will actually note that the minimum is negative 4,000 here, a loss. For beans, we have 7,000. For maize, we have 10,000. And so the maximum out of those minimums is 10,000 as compared to 7,000 and negative 4,000. And so the decision is to plant maize because it is the best of the worst alternative. And moving to the third technique, Laplace criterion of rationality. In this technique, the assumption is that all the three states of nature have an equal probability of happening or are equally likely to occur. And so we are saying that experiencing high rainfall, moderate rainfall, and low rainfall is equally likely to happen, meaning that the probability of each is actually 1/3. So we calculate the expected monetary value, and we are saying the expected monetary value of wheat in that case will actually be 1/3 multiplied by 16,000, which was the returns of high rainfall, plus 1/3 multiplied by 2,000, which was the returns for moderate rainfall, and then we have plus 1/3 multiplied by negative 4,000, which was the loss if we were to plant wheat and experience low rainfall. And we will do the same for beans, and we will do the same for maize. So basically, expected monetary value is the summation of all the returns multiplied by their respective probability. Now, in this case, we are saying Laplace assumes equal probability, and that is why we are multiplying by 1/3 all through. If then we do that, the EMV of wheat gives us 4,667. The expected monetary value of beans gives us 10,333, and the expected monetary value of maize gives us 10,000. And so in this case, beans gives us the highest expected monetary value of 10,333, and so the farmer is advised to plant beans. The minimax regret criterion is our fourth technique. And we first look at what is a regret. Now, generally, we will talk of opportunity loss as a regret. But what is opportunity loss? Basically, the benefits you forego by choosing one alternative against the other. And so generally we can say that a regret is the opportunity loss that occurs from taking one decision given that a certain contingency occurs. When you actually analyze and decide to plant wheat, but then rainfall becomes so low that you cannot maximize your returns at 16,000, you can only end up getting a loss of 4,000. And so in this case, that is what we are calling a contingency. So for each state of nature, the opportunity loss will be computed as maximum payoff minus the payoff under each alternative. And we will actually look at that from our table. We will actually compute that together. And so if we are to look at our table, our matrix, we had wheat, beans, and maize. And here we had rainfall, all the outcomes, and we have high rainfall, we had moderate, and we had low. And while at that we had 16,000 here, we had 2,000, and we had a loss of 4,000. And for this, we had 12,000 returns, 12,000 again, and 7,000. And for maize, we had 10,000 regardless the amount of rainfall. And so if we are to compute the regret table, then in that case, this is the regret table. In that case, we will pick the highest or the maximum payoff under each scenario. And if we plant wheat, then the maximum is 16,000, because we are comparing 16,000 to 2,000 to a loss or a negative 4,000. So the maximum payoff under wheat is actually 16,000. The maximum payoff under beans is 12,000. The maximum payoff for maize is 10,000. But then we can look at the scenario in a different way. If we experience high rainfall, because we will only get one outcome out of the three. We cannot experience the three together or two together. We can only have high rainfall or moderate or low. So if we have high rainfall, then it means that the maximum payoff is 16,000. The maximum here is 12,000. And the maximum here is 10,000. But then when it comes to calculating the regret table, it is good to note that we do not use the alternative, we actually use the outcomes, because these are the outcomes we want to evaluate. So then we are picking 16,000 as our payoff, maximum payoff, then we deduct the payoff under each alternative. So if you get 16,000 and minus 16,000, then the regret here is 0. If you get 16,000 and minus 12,000, the regret is 4,000. 16,000 minus 10,000, the regret is 6,000. That yes, I planted maize, I forwent wheat, which would have given me more. And so you will be regretting that 6,000. Then we have 12,000 as our maximum for moderate rainfall. And so if we calculate the regret, maximum payoff minus the payoff in each alternative for wheat, then we will have 12,000 minus 2,000, which is 10,000. Then we have 12,000 minus 12 is 0, and then we have 2,000 for the last one. Then we go to low rainfall, and we have 10,000 minus negative 4,000. This is a negative, this is a loss. So that will give us 14,000. And then we have 10,000 minus 7,000, which will give us 3,000. And finally, we have 0. So our regret table becomes this, which we have actually to use with our technique. And our technique, Minimax, looks at basically minimizing the maximum regret that we can have. And so the table as computed, the regret table as calculated is as this. We have wheat with 0 regret, 10,000 and 14,000. Then we have 4,000, 0 and 3,000 for beans. And we have the regrets as 6,000, 2,000 and 0 for maize. So the maximum regrets for wheat is 14,000. For beans is 4,000. For maize is 6,000. Our criterion is Minimax regret criterion. So we are minimizing the maximum regrets. So you choose the maximums, which we have done, and then you minimize on them. So out of 14,000, 4,000 and 6,000, the minimum is 4,000. So the decision becomes to plant beans because it minimizes the maximum regrets. Now the next technique is expected monetary value. Now the expected monetary value is quite similar to Laplace criterion, but then we are looking at a scenario where we are using the actual probabilities given. Note that in the question that was given, the probability of high rainfall was given as 0.3 or 30%. The probability of moderate rainfall was given as 50% or 0.5, and then we had 20% for low rainfall. And so in this case, we are multiplying the returns with their respective probability and then sum up that to have the expected monetary value. So for wheat, then we pick 0.3, the probability, multiplied by the return under high rainfall, plus the 2,000 multiplied by 0.5, the probability of moderate rainfall, and then plus negative 4,000 times 0.2, the probability for low rainfall. And that gives us 5,000. If you do the same for beans, you get 11,000. If you do the same for maize, you get 10,000. And so in this case, you choose the highest. We have 5,000, 11,000, and 10,000, and that comes to 11,000 as our highest. And so the probability, the decision is to plant beans because it yields the highest expected monetary value. And then we proceed to the next expected opportunity loss. And in this case, opportunity loss, we already have our regret table, and so we are only multiplying with their respective probability and summing up. And so in this case, you get the probability of high rainfall, which is 0.3. Under high rainfall, wheat had a 0 regret, plus 50%, or the probability times the regret under moderate rainfall, 10,000, plus 0.2 multiplied by 14,000, the regret under low rainfall, and that gives us 7,800. If you do the same for beans, you get 1,800. If you do the same for maize, you get 2,800. Being that we are talking of opportunity loss or regrets, then we wish to minimize our regrets. So we choose the lowest, which is 1,800. And that means that our decision is to plant beans because it yields the lowest expected opportunity loss. In our next lesson, we will discuss the following techniques which form the decision-making techniques. We have the standard deviation, variance, coefficient of variance. These three measures the risk and have been covered quite extensively in business statistics, but we will be discussing them in our next lesson. We will also look at decision tree, and we will also look at portfolio analysis and grid analysis. For your revision, I have a question. Please look at the question. Assume that ABC Limited is trying to set the selling price for one of its products and 3 prices are under consideration. So then in this case, we are choosing a price. These are, we can sell at 4 and 30 cents, at 4 shillings and 40 cents. And the following information is available. We have conditions, we have the best possible, the most likely, and worst possible. The alternatives is either to set the price at 4 and 30 cents, at 4 shillings and 40 cents. And the data on the payoffs or the returns is given in this table as indicated. We have the fixed costs for each scenario is 20,000, and the variable cost per unit is 2 shillings. So you are required to advise the company on the best price to set. You can work that out, and that brings us to the end of lesson 1. Thank you.
These televised lectures supplement our robust online learning going on our MKU online platform. You can view more on our televised lectures via our online platform. We are in a digital era, and Mount Kenya University knows this. The following are the steps to follow so as to complete your online application. Download the application form from the website www.mku.ac.ke. Attach copies of your academic certificates and ID. Pay the application fees via M-Pesa pay bill number 270988. Your ID is the account number. 2,000 shillings is the charge for a postgraduate. You can also deposit in the bank accounts provided on the website. Then email all the above to apply@mku.ac.ke.